Exchange-traded funds, ETFs, which trade on an exchange like stocks, enable investors to purchase a variety of equities or other assets in a single fund with, often, modest fees. In the last 10 years, ETFs have gained enormous popularity and currently manage billions of dollars in assets. Where can a potential investor begin when there are literally hundreds of ETFs available? How does an ETF operate and what is it? Stocks, bonds, and sometimes commodities may all be held in positions by an exchange-traded fund. The majority of the time, ETFs maintain holdings in the index businesses at their same relative weights in the index, such as the Standard & Poor's 500 or the Nasdaq 100. The investor basically buys a small part in all the assets held in the fund by purchasing one share of the ETF. ETFs often focus on a certain stock group. One of the most popular themes is an S&P 500 index fund, but other popular themes include value or growth stocks, dividend-paying stocks, country-based investments, disruptive technologies, particular industries like information technology or healthcare, different bond maturities, short, medium, and long, and many others. Here are the top 10 ETF investment strategy. Before starting, don't forget to like and subscribe to our channel for more future updates. So let's start. Number 1. Passive strategy. ETFs own a variety of equities, making it simple to build a diversified portfolio, including one that passively replicates the whole global market. You may choose a few ETFs that, when combined, cover the fundamental asset allocation categories of bonds, foreign and developing markets, small, medium, and large cap, growth, and value. The Vanguard Total World Stock ETF, VT, and the Vanguard Total Bond Market ETF, BND, which reflect the worldwide stock market and the U.S. bond market, respectively, including all asset classes, are two examples of funds you may choose. Number 2. Dollar cost averaging strategy. A long-term investing technique that works with all sorts of assets, including ETFs, is dollar cost averaging. Consistency is the secret. The idea is that you make the same investment each week or month in the same amount, buying shares at the market price. You may purchase more shares for your money when the price is low. Less shares will be given to you when it is higher. It's a tactic that, over time, will enable you to accomplish the main goal of investing, which is to purchase more when something is affordable and less when it's costly. Number 3. Low volatility investing strategy. Some investors just cannot handle the daily ups and downs of the markets, even when the market is trending higher. Low volatility investments often don't see the same price fluctuations as the market as a whole. While some ETFs utilize a hedging approach to reduce volatility and hold companies that typically keep stable in both up and down markets, others use equities that are explicitly chosen to be low in volatility, such as the iShares Edge MSCI Min Volume USA, USMV, ETF. Number 4. Trading strategy. ETFs may be traded all day long on the main exchanges, much like stocks, in an effort to outperform market returns. Day trading entails making a lot of fast deals all in one day. On the other side, swing traders take somewhat longer positions, ranging from a few days to a week or more. To ascertain an investment's inherent worth, traders may employ technical analysis, which involves examining historical prices, trends, and charts, or fundamental research, which includes stock news and the use of economic and financial data. When making short-term transactions, keep transaction fees in mind and be aware of the many dangers involved before proceeding. Number 5. Sector strategy. ETFs' exceptional capacity to invest in whole economic sectors with promise is one of their best features. A sector approach runs the risk of certain firms in the sector outperforming others. However, ETFs may help you hedge your chances by enabling you to invest in several businesses in the same industry. You may, for instance, choose an ETF that solely invests in healthcare equities or financial services firms. When they anticipate a certain sector's downfall, sector investors may also participate in short selling. Number 6. Bond ETFs for income generation strategy. Investors who are close to retiring often search for a method that can provide income without taking on a lot of risk. Bond ETFs are excellent for this use. A variety of ETFs, such as those that hold long or short-term treasury bonds, corporate bonds, or municipal bonds, are available for purchase. Alternately, you might choose a single ETF that holds all of these different bond classes. You may add a high-yield stock dividend fund to your portfolio of varied income-generating ETFs to make it more diversified. Just steer clear from volatile, risky bonds referred to as junk. Number 7. Leveraged trading strategy. By using financial derivatives and debt securities, leveraged and inverse ETFs have the potential for massive rewards, but they may also result in enormous losses, just like any speculative approach. For instance, the ProShares Ultra Standard & Poor's 500 Index ETF offers daily returns that are twice as high as those of the S&P 500. The positive returns are also doubled, so 1% decline in the index translates into a 2% decline for your investment. That's excellent if the index rises. These unpredictable investments are not suitable for those with weak hearts when you consider the risk and the sometimes expensive management fees and charges. Number 8. Robo Advisor strategy. For some investors, the set it and forget it method of investing is effective. A Robo Advisor is a computer application that uses computer algorithms to manage your money in accordance with your objectives and risk tolerance. The majority of Robo Advisors employ diversified ETF portfolios, reinvesting dividends and rebalancing the portfolio to maintain the prescribed ratios. The fact that everything is automated results in generally inexpensive fees. For instance, Schwab Intelligent Portfolios does not charge management fees but does have a $5,000 minimum investment requirement. The fundamental service provided by Wise Banyan is free and just requires a $1 minimum commitment. Number 9. Asset allocation strategy. Asset allocation, which entails assigning a part of a portfolio to several asset classes for the purpose of diversification, including stocks, bonds, commodities, and cash, is a potent tool for investors. Depending on their investing time horizon and risk tolerance, beginners may easily apply a basic asset allocation plan thanks to the low investment requirement for the majority of ETFs. Number 10. Swing trading strategy. Swing trades aim to profit on big fluctuations in stocks or other financial assets like currencies or commodities. They might take days or weeks to complete, in contrast to day deals, which are seldom kept open overnight. ETFs may be used for swing trading because of their narrow bid-ask spreads and diversity. Additionally, a newbie might select to trade an ETF that is based on a sector or asset class where they have some particular experience or understanding, since ETFs are accessible for a variety of investment classes and industries. Whatever ETF investing plan you choose, be sure you are aware of the risks and any associated costs. Only choose ETF strategies that you feel comfortable with, since not every ETF strategy is suitable for everyone, particularly if you're interested in learning how to invest. This is all for today's video. What do you think of our video? Feel free to express your ideas in the comment area below. Don't forget to like and subscribe to our channel for more future updates. Thanks for watching.